Well, hello everyone, and welcome to our exclusive event, The Road to Retirement. And this is going to be specially applicable for government employees, especially in Minnesota, because we're going to talk a lot about some government benefits that workers for municipalities, counties, the state even, all get to participate in that are unique from what private sector employees get to participate in. So I'm really excited to hear. We're going to talk about a lot of information. Let me just jump into it. And where we're going to start is with me. My name is Anthony Gerby. I'm a financial advisor with Stein Financial Group, and our group has a ton of experience with governmental plans. In fact, we've worked with many of them in the past, including a ton of experience with Hennepin County in Minnesota. So we know a lot about these plans and kind of the ins and outs of how to deal with coordinating the benefits and all that. And that's what I want to get into today, because how you use and take advantage of your benefits really sets you up on the road to retirement and thereafter. So let's get into it. Please feel free to pause the screen right here. I'll try to get out of the way a little bit so you can see the different disclosures we have here. I'm not going to read them all, but please pause the screen, take your time and read through them. Just gives a little bit more information. And with that, let's go to our agenda today. And our agenda is three different items. So number one, we're going to talk about retirement. Number two, we're going to talk about what you need to think about in order to prepare for retirement. And number three, once those things are done, let's live it. Let's retire and live the good life. And we'll give you maybe not tips on how to do that. That's going to be specific to you, but tips on what to think about, what questions to ask yourself or the people you work with to help manage your money to set yourself up for the best possible retirement here. So, number one, how do you know if you're ready to retire? Well, obviously, this is different for everyone, right? Everybody's got unique circumstances, but I like to think of it as there are three legs to the stool here. Number one is your income. So, what income do you have to work with both while you're working and once you're in retirement? So, working income is from your job, most likely. And in retirement, it's going to be from governmental employees have a pension in most cases, plus potentially you're eligible for Social Security. So those are often the two biggest facets of income in retirement. And we need to figure out, okay, what are those amounts going to be, number one? And number two, how does that affect, our timeline? Would they increase if you work longer? Is it worth it then for you to work longer to increase your possible pension and Social Security payouts? That's a question we have to kind of answer case by case. Number two, your assets. That's the second leg of the stool. So while you're working, you're mostly focused on accumulating those assets through your deferred comp plan, for example, your 457 account. But once you retire, now you've got those assets and they can still grow. I mean, we still want them to grow. But now you're probably going to be more focused on using those assets. And you use them for the third leg of the stool, which is your spending. That's the fun part, right? So the three legs are your income, your assets, and then what you're going to spend those income and assets on, right? That's the fun part. And that's how we determine whether you've set yourself up for a successful retirement. Do you have the income and assets to build a spending pattern that works for you? Or do we need to make some adjustments to the plan, right? So that's kind of what we're always trying to determine here. And there are some big questions when it comes to just the income leg of the stool. Number one, is your pension going to be large enough to live on when you retire? And for a lot of people we work with, the answer might be no. I mean, the second question here, when should I take Social Security? That may be the supplement that you need to your pension in order to make all of that work. But it also might involve your assets, which we'll get to in a second. But the big question to start with is, what income are you entitled to, right? And from there, how far does that get you toward what you would like to be able to spend? That's the question we need to answer about income. And the big reason we're doing this is number three, which is, can you fully retire and never have to work another day in your life, right? That's the first part of that question. Second is, how can we do that in such a way that you won't outlive your assets? That's really where the rubber meets the road. So retirement assets, this is the second leg of the stool. For government employees, you most likely have a 457 deferred comp account. You may also have a 403B, or I should say also, instead of 457. Those are your work retirement plans. And the reason they have those numbers associated with them is that's just the tax code that authorizes that type of account. Very similar to a 401k. 401k that's the code or the number of the tax code that authorizes that. 401ks are for private companies. So you may think of your retirement account as a 401k, but really what it is most likely a 457 deferred compensation account. Rules are very similar, so you wouldn't be wrong in kind of lumping those two into a similar category. But basically, for most people, and in our experience, in my experience, this is going to be your primary asset. That doesn't mean you don't have other assets, whether it's investment accounts. Certainly, you could look at your house like an asset, but I'm more talking about your investment assets at this point. So you could have an investment account that you started when you were younger. You could have an IRA or a Roth IRA. Those would all be on top of your 457. But just in my experience, most governmental employees, the vast majority of the assets are going to be concentrated in this 457 deferred comp. So that's what we're going to kind of focus on today as I go through kind of the rules and the ins and outs of that type of investment. There's going to be 6 things that we want you to take home from this presentation specifically about 457. I've got 4 of them here. The next 2 slides go through the next 2. So first off, how is a 457 taxed? Number 1, it depends on the type of your 457. You could also have a Roth 457, and that's taxed a little bit differently than a regular 457. I'll explain both of them. So a regular 457, when the money comes out of your paycheck and goes into the account, right? That's the deferred compensation part. It's not taxed. That comes off your income for the year. The trade-off is when you start taking money out of the account, it is taxed. So that means when you withdraw money, once you're no longer working for your employer, and you don't have to be fully retired, by the way, to use the money, you just have to be no longer working for your employer. That money is taxed as income. So it's like you're getting a paycheck for that money. You report it as taxable income. A Roth 457 is kind of the other side of the coin. So the money that goes into the account out of your paycheck again is taxable in the year you earn it as you're in your working years. On the flip side, it is not taxed when the money comes out of the account later on. Not even the gains are taxed. So both of those are a powerful tool. And really the question we should be asking ourselves is, am I in a higher tax bracket now, or will I be in a higher tax bracket later when I want to use the money? Because if you're in a higher tax bracket now, then it's better to do a regular 457 because you're getting the tax break now. If you think you might be in a higher tax bracket later, it might be better to do a Roth 457 because then you're paying the taxes now and not later. There's pros and cons to each approach. If you want more information, we'll have to go into it in more detail for you, but that's kind of a broad overview. What are the rules on investments? Well, usually, and this is true for most of the 457 plans we've worked with in Minnesota, there's a roster of funds that you can choose from, of investments. Those range from stock funds with diversified holdings of many stocks all in one particular investment to bond funds or fixed rate funds that have nothing to do with the stock market. So there's a wide range of available investments. And you often, in most plans, have the option to choose any or all of them for your account in particular. What you want to choose is really the question. And that really depends on where you're at in your working life. Are you closer to retirement? Are you a long ways off from retirement? And once you're retired, where you're at as far as, do you need to take money out of this account? Or is this just kind of extra money that because of your pension and Social Security, you won't really need? All of that determines what sort of investments you should be looking at. And again, that's something we would look at on an individual basis with you. So please get in touch with us if you'd like a little more info about that. How do you withdraw money from your 457? Really common question. Don't feel bad. It seems like something everybody should know, but when you start your 457, you're not really worried about withdrawing money because it's so far in the future. So how you withdraw, most plans are going, or I should say all plans are going to have at least an 800 number. Some may have a website that you can call or a website that you can use to set that up. So you'd call the number, you'd get a rep on the phone. You'd say, I'd like to withdraw money from my 457 account. Here's my identifying information. Here's what I'd like to do. They'll set all it up for you. They'll either send you a check or you can set up direct deposit. Some plans, for example, the Hennepin County plan in Minnesota, have servicing agents directly sent to the plan or to a particular vendor of the plan. So for example, in Hennepin County, you can choose to work with the state of Minnesota. You can choose to work with Fidelity. You can choose to work with Voya. Those are the three main ones. And Voya, for example, which is where we have some experience in the past, has servicing agents that you call that are specifically dedicated to that plan and will help you get the money out. They're kind of like, instead of having to call a random person on an 800 number, you get a person who does this every day and who is going to be consistent in that role. So it's a little bit easier that way, but either way, you call someone associated with the plan. If you don't know who to call or what the number is, A, it should be on your statement, but B, if you really don't know or you don't have a most recent statement, get in touch with your HR or your benefits coordinator because they should have the contact info that you need. So you call up and you say, I'd like my money. They'll say, great, as long as you're eligible, which is a key point. You have to be separated from service for most of these plans. And what that means is no longer working for your employer that you set up the account with. You have to be separated from service in order to access the money. However, a lot of these plans, you may have heard of the 59.5 rule, which is true for most 401ks and IRAs, for example. That does not necessarily apply. So what that rule is for those other types of accounts is you can't get at your money before 59.5, age 59.5, without a penalty. That, for the most case, for the plans we've worked with, we have experience with, I have experience with, is not the case. You just have to be separated from that employer. You could be 55 and separated and still get at the money. You want to double check that before you go through with anything. Double check what the rules are. But just, I'm giving you kind of the practicality of what we've experienced. So you call up or go online or talk to your servicing agent and say, I'd like to withdraw some money. They'll make sure you're eligible. They'll make sure there's not going to be a penalty. And then they'll ask you direct deposit or check. And it really is that simple. You may also want to withhold taxes, remember, because if it's a regular 457, it's going to be taxable. Just something to think about. What are required minimum distributions? Well, that is for a 457, whether it's regular or Roth, requires distributions once you turn 72, which means you have to start taking money out of the accounts when you turn 72. And the amount you have to take out, it starts at less than 4%. The percentage you have to take out escalates every year, but it starts at less than 4%. Or another way to think about that is 4,000 for every 100,000 you have invested, right? And that percentage does escalate every year. It's determined on December 31st of the year prior, by the way. And it's just something that you've got to do, especially for regular 457s. There's really no way around it. But for Roth 457s, this is important. A Roth IRA, which is an individual retirement account, that's what IRA stands for, you are eligible to move a Roth 457 into a Roth IRA, just like you're eligible to move a regular 457 into a regular IRA. But Roth IRAs do not have required minimum distributions required of them, while Roth 457s do. Why is that important? Well, remember I said Roth 457s are not taxable, just like Roth IRAs are not taxable. The money that comes out is not taxable because you've already paid on the money that's gone in. So if it's not taxable, why would you want to be forced to take the money out like you are in a Roth 457? Why that rule even still exists is a little bit questionable. They might be thinking about removing it because it really serves no purpose. There's no point to forcing people to take the money out because it's not taxable anyway. But that's one big pro to consider a Roth IRA instead of a Roth, or once you are retired, you could move a Roth 457 into a Roth IRA. More details on that a little bit later, but it's for now, it's just something to have in the back of your mind. All right. So number 5, what happens to my 457 if I die? Okay, there's a couple different ways this could play out. First off, we want to have your beneficiaries set up in the account, because if you don't, it's going to go to probate. And that means the state is going to determine who your next of kin is and who should be receiving these assets. But you can override that by having beneficiaries set up. So that's number 1, have your beneficiaries in place. If your beneficiary is your spouse, it's very simple. The account goes to your spouse like it was your spouse's account the entire time. They basically just put their name at the top, and they're able to continue with those assets without any penalties or any weird restrictions or anything like that. It's a very clean process for a spouse. If it's not a spouse, and that includes everybody from kids to non-relatives, non-spouse, the rules are a little bit different. If the non-spouse is more than 10 years younger, again, kids would be a good example of this, they are going to have 10 years to cash out your account from the day that you pass it on. And they don't have to take anything out in the meantime. They could take it all out 10 years from now. But the reason they do that, if that is forced, is because that's how the money gets taxed, right? On a regular 457, that money gets taxed when it comes out of the account. So the heirs, yes, are going to have to pay the taxes. But you can do it over an even 10-year withdrawal schedule. So you take out 10% a year, more or less. And what that does is it splits the tax bill for the beneficiary. So this is not you, this would be whoever your beneficiary is, over those 10 years to try to minimize the tax hit as much as possible. But the thing to know is they are going to have 10 years to cash out the account completely. In other words, on the 10th anniversary of receiving the account for your beneficiary, that's more than 10 years younger, that account has got to read $0 at that point. That doesn't mean they have to spend the money. Remember, they can take the money out and just reinvest it in something else, but it's got to be out of the account that they've inherited. That's the key. Now, for a non-spouse that is less than 10 years younger than you, let's say a brother or sister, and this would include someone who's older than you, by the way, too, they are allowed to stretch the account over the rest of their life. So instead of having 10 years to cash the money out, they are allowed to keep the account in force for the rest of their life, as long as they take the required minimum distributions every year. And there's a different percentage table for that they're responsible for keeping track of. If you've dealt with this yourself, this used to be the only way it was done. By the way, the rules changed a couple of years ago to add that new 10 years and out rule that I just went over. But it's key if you or someone you know, or even someone you're thinking about passing the money on to, has a less than 10-year age gap, that you understand what those rules are, the RMD rules. Again, if this is your account and you're passing it on, just advise who's ever set up to inherit it, hey, you might want to look at this. But at that point, it's really not your problem anymore. So what options do I have now that I'm no longer working that I didn't have before? So this is once you've separated from service, would be the way I would term it. You're no longer working for the employer, whether it's a city, county, state, what have you, that set up your 457 account. Number one, you can roll that account into an individual retirement account. And there are pros and cons to doing that. Some of the pros are you might have better investment options. I emphasize might because we don't know until we look at it, but that's a possible pro. A possible con is it could be more expensive. So what we need to do are weigh the pros and cons, and there are more pros and a few other cons too that I won't get into all of them right here because they're specific to any one individual situation. But we need to see if that makes sense, at least check on it, because there are some ways that it can really be beneficial tax-wise, or even just simplicities, for simplicity's sake, I should say, that do make it attractive to roll over. But whether that's right for you is totally dependent on your situation. It's definitely not right for everyone. I would never say that as a blanket statement. 2, consolidate with other qualified accounts. So if you have, for example, a traditional IRA and a traditional or regular 457, not a Roth, those two accounts can be combined. They can always be combined into the IRA or into a new IRA even. Sometimes you can put the IRA into the 457. That's a little bit trickier. It kind of depends on what your plan is. So you'd have to double check on the rules there. We could help you double check with that. But oftentimes it's a good idea to think about doing that at least because of simplicity. If you've ever had to clean up for a loved one who's passed away and they have accounts scattered all over the place, right? It's nicer if they have fewer accounts to deal with. So that's one of the main benefits of doing that. And number three, which I won't block here, you don't have to do anything. You can leave your money in the retirement plan that you set up at work 40 years ago when you started, right? You don't have to move. And that is totally a valid option that I think is often overlooked. People think, well, I have to do something now that I've retired. No, you don't have to do anything. You only want to do something if it's going to be in your best interest to do it, right? If the pros, in other words, outweigh the cons. That's something we do on a daily basis. We'll help you go through the pros and the cons. You'll make the final decision, but we'll shop around and say, hey, if you were going to make a move, for example, this is, I think, the best you could do. And we'll say, here's the pros, here's the cons, and you'll make the decision about, yeah, I think that does sound worth it for what I'm looking for. Or, no, I think I'm doing just fine where I'm at. Both of those are totally valid. So don't ever feel pressure to move an account away from where it's at. You only want to do that if it's better off for you to do so. So how does your 457 coordinate with your income? Remember, we were just talking about assets. Now, how does those assets and income work together? So your pension and your Social Security, one of the big things to know, pension and Social Security are both taxable. By the way, a lot of people don't realize that. Your Social Security is taxable. Taxable a little bit, well, not differently. It is taxable as income. But for most people, only 85% of your Social Security check is going to be actually taxable. So, that's a difference, whereas 100% of your 457 and your pension are taxed as income, but they're all taxed as income. So what we found is you can have a pretty big income tax bill in retirement if you've got all three of these things going at once: a pension, Social Security, and a 457. We've got to think about that, especially if you have even other investments on top of that. How do we mitigate those taxes and make it everything as tax efficient as possible? That's the question that's got to be on our mind. And secondly, do we even need to use our 457, or does our pension and Social Security cover our income needs plenty? And if that's the case, that's going to lead to a different conclusion about how to invest your 457, right? You might be a little more aggressive if you don't need the money, because you're saying, well, if I need it, it's there, but maybe this is just legacy money for the kids. Maybe you're on the total flip side and you say, no, I need this 457. I need to use it to supplement my income. How do we make that work? Those two scenarios are totally different ends of the spectrum as far as how you invest and how you think about a 457. So we've got to determine where you're at before we can give you an answer to that question. How do you use it most effectively? So I talked about the taxes, right? And the investment risk goes back to that different ends of the spectrum that I kind of just illustrated right there. Whether you should be risky or conservative, A, depends on your personality, right? That's the main thing. But B, it also depends on your situation. Again, if you're saying, I don't need this money, my pension and Social Security are doing great for me, maybe you are a little bit more aggressive and get a little bit more growth, or at least that's the goal. If you need it for income, maybe you're a little bit less aggressive. And what we need to do is figure out where you fall on that spectrum, from risky to less risky. And if we can do that, we'll have a much better idea about A, how best to manage your money so that it works for you and lets you live the retirement you want to live, and that you don't outlive it, right? Because that's maybe one of the biggest thing that we can avoid. And two, whether it's going to be better off for you to be in your original 457 account, or whether you're going to be in an IRA, for example, that you'd roll into. Now, I've been talking mostly just recently about retired folks, right? Who maybe need this money as income. If you are still working, remember, you can't even take the money out until you're not working anymore, or at least not working with your current employer that's offering the 457. So most people in that stage are going to be accumulators, right? Maybe on the higher end of your personal risk scale, you're going to want growth. You're going to want the money to continue to compound for as long as it possibly can. And yeah, you might adjust things as you get closer to retirement. That's pretty normal. But for the most part, you're going to be in the accumulation phase. So just another thing to think about. I know this slide is about in retirement, but I want to talk about the whole picture here too. So what are the things to best practice? What are the things to remember when it comes to your 457? Number one, we need to look at pros and cons of either using your investments or turning on Social Security sooner or later. Some people don't know. You can wait to take Social Security. You don't have to take it as soon as you retire. The earliest you can even take it is 62, and the latest you would ever want to take it is 70 because it doesn't grow after that. So whether you wait until 70 and use your investment assets, your 457, to pay out the income that you need between your retirement and then, that's a big question. And we can only really answer that by running some analysis, by seeing what would the check be if you waited from Social Security? What would the tax bill be from using your 457? What would that do to your assets? Would that put us in danger of outliving our assets, for example? All those things need to be taken into account. We need to invest for the long term, but as you get closer to retirement, and especially once you're in retirement, we need to be looking to the present more than ever. What is your current situation changes how we think about your investments across the board, not just even a 457 account. And don't forget to spend it. That's what it's there for. This is one of the most common problems that people run into. Not that it's a bad problem to have, but that they're worried about using the money. They say, no, I've saved for 40 years. I save into this account. I don't take money out of it. I'm telling you, eventually you do. I'm not saying you have to. Maybe you're in a situation where you don't have to. Congratulations if that's you. But the money is there to be used. We can help you use it in a way that's not going to harm your long-term prognosis here. That's not going to put your money at risk for you outliving it in the future. We need to be using it because that's what you saved it for. It's there to be used. So please don't be afraid of wanting to use the money. We'll help you figure out how to use it as responsibly as possible. That's what we're here for. So you just figure out what you want to spend it on. That's the fun part, right? All right. We're now talking about spending. That was a good segue. In general, there's three types of spending. By the way, this is true whether you're in retirement or not. But your obligations, so if you still have a mortgage, whatever your fixed payments are, mortgage is usually the best example, but car payment would be another one. Any clubs or associations or homeowners, taxes are an obligation, but we put them in their own category down there. Discretionary, that's fun. That's trips, going out to eat. Certainly one of your obligations is you've got to pay for food one way or the other. But discretionary would be, I want to go out to a nice restaurant a couple times a week. I love to go to the Guthrie and see the latest shows, or I have a season pass there. All this stuff that's not necessary for survival, right? That's your discretionary. And finally, taxes, of course. How do we balance these three with the income and assets that you have? And how do we make that work for the long term? That's always the question we're asking. So let's prepare. What needs to be in place before retirement? Okay, we need to have some idea of where our income's coming from. If you've got a pension and you're in line for Social Security, great. Let's plan on having those and figure out how those balance with the spending that you'd like to do. We need to think about healthcare. Okay, remember, when you retire, depending on what bargaining unit you're with your employer, you may have access to healthcare even once you're no longer working there until 65 when you apply for Medicare. You may not. You may need to go on the exchange. You may also retire after 65, at which point you will definitely have healthcare when you retire and up to you when you retire. So, if you're retiring after 65, not as big of a deal, but you still have to apply for Medicare. And Medicare, a lot of people, depending on what your employer's healthcare plan is, and we have familiarity with a lot of them, even if you're still working, you may want to apply for at least Part A of Medicare. Medicare is a whole separate conversation. There's a lot of moving parts there. We need to talk about it individually, but I just wanted to throw that out there. Risk mitigation, which basically means we need to determine how risky you need to be, because there's no sense in being as risky as you were when you first started working, when you were only worried about accumulating. Once you're retired or just before you retire, we need to think about preservation just as much as accumulation. And that's something we're really experienced with. We do it all the time. And finally, tax strategies. How do we make the accounts and the income you're receiving as tax efficient as humanly possible so that you're not paying any more than you absolutely need to be paying in taxes? All those things need to be done here. So, income strategies. Here's a few things to think about. Your pension is taxable. That's just full stop, taxable. Your pension does have a cost of living adjustment if you're with para attached to it. Now it's 1%. That's not a huge number, but that means it's going to grow and that's going to go up as time goes on. So we need to take that into account as well. And finally, you need to think about what version of your pension you would like. You might have heard there's a 100% survivor benefit option or a 0% survivor. What that means is 0% means when you pass away, the pension stops, full stop. Nobody gets any more money. 100% survivor means, and usually you'd use it on a spouse because that's the simplest way to think about it. You don't necessarily have to, but there's pros and cons to not doing a spouse. So most of the time it's a spouse. If your spouse is the 100% beneficiary of your pension, when you pass away, your spouse will get the exact same check you've been getting for the rest of their lives. So in other words, for both of your lifetimes, you will be getting the same check every month that you got from the start of your retirement. That's a really powerful thing for retirement planning. A lot of people ask me, well, but we get more if we do the 0%. The check is bigger up front. So doesn't it make sense to do that and worry about that later? Or what about 50%? And so on and so forth. And I'm not saying 100% is right for everybody. I think it is right for a lot of people, to be sure. But one thing you should know is that if it were to go the other way, if, God forbid, your spouse were to predecease you and you're saying, well, I really should have picked the 0% because now there's no one left for the 100% survivor benefit to go to. No, you can get your benefit adjusted back to the higher amount, the 0% amount, if your spouse predeceases you. So a lot of people don't know that. I wanted to throw that in. Obviously, we hope that situation never happens, but it's important to know that option exists in general. Social Security. Question is when to take it. Pension, you take it when you retire because it doesn't go up after that. But Social Security will continue to grow even if you're not working anymore. Between ages 62 and 70, Social Security grows and grows by quite a bit. Now, there's also a cost of living adjustment that makes it grow every individual year. And that's voted on by Congress. So it's not a certainty what that's going to be like your para would be. But that does mean there is a little bit of a bonus in there every year, a kicker that can help deal with inflation. And finally, spousal consideration. So this can get really complicated really quickly, but you are entitled as someone who was married to the same person for 10 years or more, whether you're still married or not. And if you're currently married, you don't have to have been married for 10 years. That's just if you're currently married. But even on an ex-spouse, if you were married for 10 years or more, you are eligible for 50% of their benefit. That's your spousal option. So if 50% of your spouse's benefit is bigger than your personal benefit, you're going to want to do the spousal benefit. That's one thing. Also, quick aside, well, not aside, this is important info. When one of you passes, you only keep the higher of the two Social Securities. So if you and your spouse both have Social Security, you don't keep both payments until both of you are gone. Whoever goes first, the remainder gets to choose, or really just takes, the higher of the two Social Security benefits. So you don't get to keep both checks for the rest of both of your lives, unless you're both alive for the rest. It's both of you around at the same time. Important info there. All right, health insurance. So a lot of employees, especially with Hennepin County, not everybody, but a lot of people actually have the option to stay on the county's health insurance plan until age 65, even if you stopped working there before age 65, which is a really great benefit. I mean, definitely consider taking advantage of that. So with that said, people who don't have that option may opt to go on a spouse's health insurance plan. Maybe your spouse is still working and you can just become the secondary on their health insurance plan. Fantastic. That's a great option too. And finally, the third scenario would be you could go on the private marketplace and buy a health insurance plan. And that's really probably if you don't have any other option, but you can still have health insurance if you retire before 65. At age 65, you're eligible for Medicare. And especially if you don't have, a spouse who's still working or access to the county healthcare plan beyond that, you're going to want to sign up for all of Medicare, not just Part A, like I mentioned before. And there's so much to talk about on Medicare. I could have 20 more slides on that. That's really something we need to talk individually about. Risk mitigation. So the two biggest risks in retirement are dying too soon. And that's often what life insurance covers, right? Dying too soon would be, am I going to leave my loved ones with financial obligations or just not set up well for the future if I'm not around anymore? That's what life insurance is really good with. Living too long, though, is also a risk, right? Outliving your assets would be another way to say it. And there are insurances that can help with that. For example, long-term care, which is, in other words, nursing home insurance, although it can cover assisted living and in-home care as well. That's one way to help with that, because a lot of big expenses later in life are healthcare related, right? But your assets are really the biggest insurance against living too long, outliving your assets. The best way to not outlive your assets are to do well with your assets and make sure they're not outlivable, right? And obviously all of this is relative, but that's kind of how we think about it. And those are the questions, again, you need to be asking. How can I know that I'm not going to outlive my assets, or at least be as certain as reasonably possible? So, quick reminder, following sources of income are considered taxable at the federal and state levels in Minnesota. And again, this is Minnesota specific. Some states don't have state tax. Some states do have state tax on income, but not on Social Security income. So your mileage may vary, in other words, but your para pension, your 457 when you take money out of it, and your Social Security, all taxable federal and state in Minnesota. Consider doing Roth conversions, that is turning money from pre-tax into after-tax at a time of your choosing, which can be powerful. That's a way to reduce future taxable income. And charitable giving, if you have a traditional IRA or you move your 457 into a traditional IRA, that you can do charitable giving once you turn 70 and a half. That reduces both your RMD, the required distribution, and your taxable income for the year, or it really doesn't come up as income at all. So there are a couple strategies that we can go over to really try to mitigate a lot of the taxes that you'd be responsible for. So you might be sitting there and saying, Anthony, all of this stuff about pre-retirement and making plans and all that, that sounds great. I just retired. Tell me how I did. I'm already past the point at which a lot of that advice even matters anymore. I'm retired. Now what? Okay, we need to talk about estate planning. This is, again, an incredibly dense topic, so I won't be able to get into all the nuances today. But in basic terms, you need to set your beneficiaries as well as you can. We highly recommend you get a will and keep it updated. That's going to help you control what happens to your assets. And the bigger your family is, and sometimes it doesn't even matter if you have a big family, what you want to be able to control how this happens. You might not need to, maybe, things are going to be set up in a pretty easy and smooth way, which is how your family works or how your heirs you'd like to be set up. But please consider having a will and keeping it updated. We think it's incredibly important. You may also consider having a trust. And what a trust is it basically allows you to move your assets upon your passing into the trust instead of directly into your heirs' hands. That allows you a little bit more control. And there are pros and cons to doing it. We need to have an individual conversation. I sound like a broken record about whether that makes sense for you or not. Because again, there are pros, plenty of pros. There are also some cons. So, you need to think about that. But we highly recommend that you put a will in place. And we recommend you at least consider a trust and see whether that would be appropriate for you or not. Also, I'm going to rattle these off quickly, and I won't have definitions on the screen, but they're worth considering. Power of attorney or durable power of attorney, that helps with legal affairs if you become incapacitated or just on your behalf. And medical durable power of attorney, that is making medical decisions for you when you're incapacitated. Those things also would be important, we believe, to have in place, just to be prepared for the future. You can also gift money, by the way. This can be a fun part. If you've got money that you don't necessarily need and you'd like to see it, it used while you're around, not just inherited when you're not around anymore, which I recommend. I love seeing, grandparents who are able to give the grandkids or kids a little bit of money and seeing it put to good use while you're around rather than just having them inherit it one day. That's a fantastic gift to give your loved one, but also yourself, right? There are ways to do that minimize the taxable impact. So we need to talk about that if that sounds at all relevant to you. And lastly, enjoy it. I mentioned these. The only one I didn't talk about was living will. That is a directive that says what you would like to happen should a medical situation advise and you're not conscious or active enough to make that decision actively in the moment. So a lot of the ways people think about it are, what do you want your end of life decisions and healthcare to be like? You can put that in writing and no one can override that once you put it in writing. So if you've got opinions about that, it's probably important that you get that down on paper. Gifting strategies. I don't need this money. What should I do? Well, you could give it to charity. And often cases, one way or another, we can get you a pretty good tax benefit for doing so. So if you give to charity already, we need to be talking about that because we need to be making sure that you're doing it in the way that gives you the best taxable benefit for doing so. It's fantastic to give to charity. Obviously, the number one reason to give to charity is to give to charity. It's good for its own sake. But while you're doing it, our job can be to get you the best tax benefit for doing so. At least, get you the best bang for your buck. So that's something we do a lot. Again, it's something we have to think about on an individual basis. And just estate planning. So if you don't need the money, probably what that's going to mean is there's going to be some left over. Whether it's a big amount or a small amount, we still need to think about it, at least according to who would you like to inherit that money. How would you like them to inherit it? All at once, over a period of years? Do you want to, just to throw out an idea, do you want to have that money go to charity, but maybe set up a charitable trust so that your heirs can dole out money every year to different charities that they and you find important, and you've set that up for the rest of their lives, maybe? It's a great way to establish a legacy, but we've got to plan it in advance. It's not something you can do at the last minute, when you're advanced in years and maybe there are healthcare problems. It's going to be a lot harder to do it then than to be proactive and do it now. So I haven't talked about investments so far as the fact that they can go up and down, but obviously that's a huge piece of the puzzle here, right? Market volatility, meaning the market going up and down, and therefore your investments going up and down, is inevitable. Remember that markets go up and they go down, and we need to be prepared for both circumstances. Obviously, no one has a crystal ball to know what's going to happen tomorrow, a year from now, or 10 years from now. We can have educated guesses. We can try to set ourselves up to put ourselves in the best position to succeed, but there's no way to know for sure. Depending on how important your assets are to your overall retirement picture, we need to have a plan in place that mitigates risk to the amount that we can while allowing you to participate on the upside to the extent that you need to. And what I mean by that is, if you need to earn money to make a retirement work, which most people would fall into that category, we need to have some exposure to investments that are going to allow your account to go up, right? And that usually involves taking risk. But how do we do that in the smartest way possible so that when we do have market volatility on the downside, that it doesn't put your retirement in jeopardy? It doesn't put your retirement date, for example, push that further if we have a down market period. Or it doesn't put the amount that you're able to take out of your account in jeopardy because the market's down once you're retired. We are really skilled at trying to build accounts, and there's no perfect way to do it, but this is what we do every day. We try to walk that balance between mitigating risk while still allowing for upside. And we highly recommend that we sit down and have a conversation about what that might mean to you specifically. So it's better to live rich than die rich. Remember that, right? It's better to use your money in a responsible way. I won't advocate for irresponsibility, but it's better to use your money than to just let it sit. At least that's my opinion. And you can have a different opinion, but that's my opinion. So enjoy your retirement. It's about finding time to do what matters most. Spend time with your family, take that trip, use the money that you've worked so hard to save to live the good life, right? And don't just squirrel it away without, thinking about what would make life worth living is the way I feel about it. So remember that. We have tons of ideas, by the way, if you need ideas about, hey, we hear about everyone's trips. You hear about your friend's trips. So everyone we work with who's retired, who's going on trips, we hear about them. So we know a lot about, where would be a good place to spend the money and where might be a place to stay away from. That's just one example of something you could ask us or we could talk about that we can help you with. But I always say, I might sound like a contradictory advisor, but I often advise people to use their money, not at the expense of your retirement. We have to do it responsibly, of course, but use the money. That's what it's there for. So I love hearing the stories about what some of these savings have been able to be used for in retirement, especially. So contact us. I'll try to get out of the way here. We have available to everyone who watches this video a personal deferred comp assessment. That is, we are willing to do for you on a complimentary basis. You come in, we'll talk about where you're at specifically, all these different questions that I raised, we'll try to get you some answers as best we can. And there's no obligation to it. So I highly recommend you sign up for it. Here's our contact info to do that. And I'm really looking forward to seeing you. So please don't hesitate to reach out with questions, concerns, and again, get in touch with us for this deferred comp assessment. We think it's really going to be valuable. Thanks, everybody.